Hi, good morning. This is Mayor Valensky with Driving Markets. Hope you're well. Anything said in this piece is an opinion only. Let's kick off. Remember, you can subscribe on YouTube, on also Instagram, TikTok, etc. Okay, so let's have a quick understanding and have a look at what was driving markets last week. So the overall concern in financial markets recently has been the potential of slowdown in the economy after the private sector came out with lower employment numbers and the number of layoffs had increased. On Friday came out the official unemployment number in the US, the non-farm payrolls. Even though it was Good Friday, it was a shortened trading day on Friday. Anyhow, the numbers came out and they were in line with expectations, showing a slowdown of the rate of employment in the US. And that is going to send concerns across the whole board, across global markets, because we're now talking about going into an economic recession. Now, I've been saying all along on this channel and other media channels that we're going to go into a recession. And the recession here is going to be more harsh and more severe than the one back in 2008, and obviously the one back in the dot-com crisis, which most traders who are trading at the moment under the age of 30 don't even know what that dot-com crash was. Okay, that was back in 2000. The economic recession is going to be pretty severe as layoffs increase. Now, once layoffs increase and unemployment rises, then you're going to have a knock-on effect of individuals, Joe Public, not being able to pay their mortgages, their debts, their credit cards, etc. And that's going to have an impact on credit card banks and on corporate earnings, because obviously the amount of money being spent will be far less than is at the moment, simply because there'll be less money around. So we are going to go into recession, there's no doubt about it. Officially, we're not in recession because GDP has picked up, and GDP, which is the official quarterly number that comes out showing the gross domestic product, the gross production for that particular country or that economy, has been positive in the UK, in the US and in Europe. So technically we're not in a recession, even though the feel factor that we're in a recession, or the amount of confidence or the amount of money you have in your wallet, in your pocket, feels as though we're in a recession. The fact of the matter is, technically or officially, we're not in a recession. I don't think we officially need to be in a recession in order to feel it. Okay, now this week coming, you've got all the banks reporting. Interestingly enough, you've got one of the banks reporting on Wednesday is First Republic. And remember, First Republic effectively had to be bailed out by the big banks to the tune of $30 billion, which is definitely not enough for First Republic. It's going to need a lot more money. Remember, First Republic is a second tier bank, and that got into the highlights, or got into the headlines, I should say, after the collapse of SVB, Silicon Valley Bank, and Signature Bank. So then came First Republic, which is a second tier bank, declaring that they had issues and they had to be rescued by the other banks, which is what's happened. However, that rescue plan was only for a few months, not forever, and we're not too sure how First Republic plans to pay back the $30 billion loan, or if it can at all pay back the $30 billion loan. And the likelihood is that First Republic will eventually fold or be taken over by one of the other major banks, or bailed out by some sort of emergency fund from the Fed or the US Treasury. Now, leading on to the banking crisis, the banking crisis is not gone, it's not disappeared, it's only gone a little bit quiet recently. But it'd be interesting if you look at Jamie Dimon's comment, what he made last week at JP Morgan to economists and to bankers. He was saying clearly that this banking crisis is not over, it's here for some time, it's going to be here for several years, or the impact is going to be felt for several years ahead of this banking crisis. Now, what's interesting, I keep going on and on about it, is which tier one bank is likely to fail. However, talking about tier one banks, you've got JP Morgan Chase, which is reporting also this week on Friday, and you've also got PNC and some other financial institutions like Wells Fargo. And what's likely to happen is they're all looking to be, or analysts expect their earnings to be down by around about 6% across the board in the financial sector. Not specifically JP Morgan down 6%, but the financial sector they're looking probably for a downward pattern of about 6%. That's the highest it's been since 2020. Okay, so the banking sector is under pressure as liquidity becomes tighter. Moving on to foreign exchange, you've got the dollar is going to be slightly weaker going forward again. I keep going on about dollar weakness. Well, it's going to continue throughout 2023. You're going to have some dollar weakness against the majors because the likelihood now of the Fed increasing interest rates dramatically is remote for two reasons. Number one, the unemployment is likely to rise. The economy is going to go into recession. And of course, you've got the banking crisis. They don't want to impose more hardship on the economy. That puts them in a dilemma because what's going to happen is you're going to have inflation is going to continue rising. But the Fed will have its hands tied in terms of economic activity because it will not be able to raise rates freely with the fear of damaging the economy even further. So that's issue regarding the Fed and foreign exchange. You've got a slightly weaker dollar and you're going to have rising majors like the pound, euro and Canadian dollar, Aussie dollar against the US dollar. Regarding gold, I've been saying for a while is going to go above 2,000. It is above 2,000 and it's probably going to continue rising all the way through to 2040 and to $2,100 an ounce. From there, it's anyone's guess where it goes. All depends if the upper limit, the resistance at that level, stops it moving any higher. Cryptocurrencies is everyone's following. Bitcoin again, rock solid at 28.5. Those of you who are bulls on crypto, then you're looking for it to move to 30, then 35. Those of you who are anti-crypto, anti-Bitcoin, don't believe in it, then there'd have to be serious regulation and a serious economic downturn for, at the moment, for the cryptos to fall out of favor. It looks like the bulls have got the bull by the horns as far as cryptos is concerned. US Treasuries down significantly, the yield is down significantly, which means the price has gone up, and that is an indication of an economic recession. Keep an eye on that. Remember, the US Treasuries, as the yield falls, then the high-tech stocks benefit from a falling yield, so they will go up if the yield falls. However, if we're going into recession, then the high-tech stocks will fall also. They're going to be laying off more people going forward. There's going to be a lot more layoffs as far as the high-tech sector is concerned because they're super overmanned at the moment. All right, this is Mayor Valensky with Driving Markets. Catch you soon.